Start with the foundation. What exactly is interest? Interest is the cost of borrowing money or the reward for saving it, always expressed as a percentage of the principal, the original amount you borrow or invest. Think of it as the price of time. When you borrow, you pay for the privilege of using someone else's money. When you save, you're compensated for letting others use yours. This simple concept is at the heart of every loan, savings account, and investment. Understanding how interest works is the first step to making smarter financial decisions, whether you're planning to save for the future or considering taking out a loan. Now let's break down simple interest. With simple interest, the calculation is straightforward. It's always based on the original principal. The formula is principal times rate times time. For example, if you invest $10,000 at a 5% annual rate for 3 years, you'll earn exactly $1,500 in interest, no surprises. This predictability makes simple interest easy to understand and plan for, whether you're borrowing or saving. You'll always know exactly what you'll owe or earn at the end of the period. Simple interest is common in auto loans, some student loans, and short-term lending products, where lenders and borrowers prefer clear, predictable payment structures. Compound interest is where things get interesting and powerful. Unlike simple interest, compound interest is calculated not just on your original principal, but also on all the interest that has accumulated over time. This means your money can grow much faster, especially over long periods. For example, $10,000 at a 5% annual rate compounded yearly for 3 years grows to $11,576.25, more than you get with simple interest. Over decades, this difference becomes dramatic. Compound interest is the standard in savings accounts, investment accounts, and retirement funds, where the goal is to maximize growth. But remember, compounding can also work against you when you're borrowing, especially with credit cards and mortgages. Let's visualize how simple and compound interest grow over time. With simple interest, your money grows in a straight line, steady and predictable. Each year you earn or pay the same amount, but with compound interest, growth accelerates, creating a powerful snowball effect. Over 10 years or more, the gap between the two becomes dramatic. For example, over 45 years, compound interest can deliver over 13 times more wealth than simple interest with the same starting amount and rate. This is why starting early and letting your investments compound is so important for long-term goals like retirement. Compound interest can be a powerful ally for savers, but a dangerous foe for borrowers. When you save or invest, compounding accelerates your wealth. But when you owe money, especially on credit cards that compound daily, your debt can grow rapidly. For example, a $1,000 credit card balance at 18% APR can balloon quickly if you only make minimum payments. The key to managing compound interest debt is to pay more than the minimum and as frequently as possible, reducing the principal before interest can pile up. Understanding how compounding works helps you make smarter choices, whether you're saving for the future or managing debt today. Wrap up, remember, simple interest is predictable and easy to calculate, while compound interest is powerful and can dramatically increase your savings or your debt over time. Knowing which type applies to your loans and investments gives you more control over your financial future. For borrowing, prefer simple interest loans when possible and pay off compound interest debts aggressively. For saving and investing, seek out compound interest accounts and start as early as you can to maximize growth. Always check your loan or account agreements for interest type and compounding frequency. With this knowledge, you can make interest work for you, not against you.